On for recording. If I come back towards the thing that we did during the previous lecture, if you clearly remember, these were the things that we have to do during the review procedures when we are finally done with the audit, and the final completion stage is made up of these six things. Now, from these six things, we are done with subsequent events. We have understood those. We are done with going concern, and today we are going to move towards the next thing we are going to move towards is review procedures and evaluation of misstatements. Both of these are written separately here, but they both mean the same thing and both fall within the same category. So let's move towards those. And the main topic, the name of the topic is review of financial statements. Reviewing the final, you are done with the audit, then you finally check out the financial statements once again to make sure that you have not missed anything out. So what is written here? Before giving an opinion, yes?
Like what we did yesterday, is it like a process? Like the first thing we talked about substantive procedure, was
Hmm.
that the first thing done? Subsequent event, is that
Yes.
the first thing done? Then they go to checking for going concern, or
No,
is
they
it
are
just
done
like together?
simultaneously because there are different teams involved. So one team would be doing going concern and the other team would be doing subsequent events simultaneously. So there is
Oh, okay.
like this process that this should be done first, this should be done second. So there is not this process here.
Right, right.
Okay. So before
Okay.
giving an audit opinion, but now these are the final things that you have to do. This is the process, like this is, you can say, the final things. After doing subsequent events and after doing going concern, then you move towards review of financial statements. Then you move towards these things. Before giving an opinion and auditor's report, the auditors are required to perform a final review of the financial statements. Now, the question is, what do they do in this review? Review the financial statements to ensure compliance with accounting standards and local legislation disclosure requirements. This is sometimes performed using a disclosure checklist. So even in my practical life, once you are done with the audit, you have checked the subsequent events, you have also checked the going concern things, and everything is done. You finally take up the final financial statements of the company, like whatever they have adjusted. You told the management these are the misstatements, and they have adjusted those misstatements. Now you take the final set of the financial statements, which are basically again draft. What is draft? Not finalized, but these are the final ones. You take this draft from the management and you start checking it whether everything, yes, we have done the audit, yes, we have done everything, yes, we have made substantive procedures on everything, we have identified the risk, but still let's check again whether all the things that have been recorded, are they recorded in accordance with the IFRSs or not. You are just checking it by looking at them. And finally, just as I told you, and I even showed you the financial statements of Nestle, there are disclosures that have to be made within the financial statements. Now, remember that the auditors have a checklist. They know that this Nestle falls within the FMCG industry. This is the name of the industry they work in. And within this industry, the law says that these are the things that have to be disclosed. The auditors will have written those down on a piece of paper, all the types of disclosure that are required by this company, that are
Do you mean like just on disclosure notes?
yes, they make their own disclosure notes. Like they have their own list of disclosures that are supposed to be given by Nestle. There will be these disclosure list of disclosures that the auditor will have. Now they will check out the disclosures of the entity and they will compare it with their own checklist. Like, is this disclosure given? Yes. Is this disclosure given? No. Is this disclosure given? Yes or no. So this basically is known as a disclosure checklist to make sure that all the disclosure are also given within the financial statement. So this is something that you review the financial statements for. The next thing, accounting policies are sufficiently disclosed. Now, if you remember correctly, when I was showing you financial statements, I showed you there are 2 or 3 pages after the financial statements in which you have to disclose the accounting policies. These are not the disclosure notes, these are the accounting policies. Like within accounting
Wait, what?
policies, let me show it to you. Let me show it to you. Give me 1 second. Let me open up the financial statements first of all. So let's open up Nestle 2023 annual report. Let's open it up. Maybe I have it downloaded still within my, let's check. Do I have it downloaded? Yes, I have it downloaded. So let's open this. So if I come down towards the financial statements, where are the financial statements, by the way? Okay, risk related to Nestle business, authorization. Let's move down. Let's move down. So are these? No, these are not the financial statements. Let's move down. Okay. You see, here is the financial statement. Consolidated statement of income. So this is revenue. Consolidated statement of comprehensive income, OCI. Then comes the consolidated statement of financial position. Obviously, we know how this is made. Then there is cash flows. If I move forward, you will find the changes in equity. If I move forward, you will find notes to the financial statements. Now, basically, these are the disclosure notes, right? This is what you understand.
Yep.
But within this, look at this accounting policies. Basis of preparation, how they have made the financial statements, they are disclosing here. We have followed IFRS and ISS to make the financial statements. This has been disclosed here. Now, if I move forward, what is written here? New standards, any new standards that were introduced that we have applied in the current year, these have been disclosed as well. So against every single type of thing that is related with the company, how they have done consolidation, it is explained here. These are basically not related to the financial statements, but the company is explaining how they have done every single thing, like what they have done. You will also study, there is a standard or regarding joint arrangements. Now, what is a joint arrangement? You don't know about it. How they have defined associates, how they selected associates, how did they interpret the accounting standards, they are explaining this. IFRS 9, which you have not studied, foreign currency, which you haven't studied right now. These are different standards that have been applied within the financial statements. They are not, these disclosures are not linked with the financial statements, but the company is just explaining how they have used the different standards, explaining every single standard. These are known as accounting policies. Got it?
Yeah.
So these are also disclosed. So an auditor will also check whether the accounting policies are sufficiently disclosed, everything has been properly explained or not, whichever is related to the financial statements. Number three thing they will look for, they adequately reflect the information and explanations previously obtained. So during the audit, you have obtained all the information, right? Every single thing, profit and loss, revenues, cost of sales, the breakup, you know what every single thing is for. So if in a disclosure you find out something else that is not related to the audit, or it does not confine the way you found out it is happening during the audit, like you understood that the revenue is increasing because of more sales made during the year, but the disclosure is given that revenue has increased because the selling price has increased. Now this does not corroborate with the evidence you obtained. Understood?
Wait. Yep.
Yeah, you understand this point, right? So this is an issue and you will discuss it with the management. So you also check for such disclosures which do not corroborate with your audit evidence. You found out something else and the disclosure is regarding something else. You identify such type of disclosures as well. These are the number three first things that you look for. The second thing, you also have to perform final analytical procedures and explain the differences in accordance with the auditor's understanding of the entity to ensure the differences meet the conclusions reached before. So you remember the basic analytical procedures, right? Basic analytical procedures. Let's make a basic analytical procedure of profit and loss. This is 2012. This is 2013. So during the basic analytical procedures, you identified that the revenue in the previous year was $2,000. In the current year, it is $3,000. You would ask the management, why is it increasing? Like, let's just talk about revenue. Why is it increasing? You will get all the understanding and then you will identify the risky areas and you will perform substantive procedure. But now you're done with every single thing. You know yourself as an auditor, you have the detailed understanding because you have done substantive procedures, you have done the risky areas, you have gone through ethics, you have gone through the financial statements a bunch of times. You know exactly why the current year revenue is increasing by $1,000. You know in detail, right?
Yep.
So within final analytical procedures, they are just like normal analytical procedures. You identify the change. So here you will write down $1,000 increase, and here you will comment on your behalf like why it is increasing. You will not ask the management now. You have your own understanding, and you will explain that according to my understanding, this is increasing because the company sold 300 more products this year at a higher selling price. The selling price also increased by 14%. Because you have done a detailed audit of the company, you will know this. And in your own words during final analytical procedures, you will explain this. Understood?
So basically, because you perform substantive procedure, you understand like why everything is changing.
Yes. So
So
cost of
then
sales,
you will.
gross profit, admin expenses against every single item of statement of profit and loss, statement of financial position, you will explain every single head separately. Like why is it increasing? Why is it decreasing? Got it?
Oh, okay.
These are known as final analytical procedures. And these are just, you just need to know the definition yourself. These are not tested within the exam. The examiner is not going to ask you to perform final analytical procedures. These are not in your syllabus. So you can relax from that point of view. So this is the second thing. The auditor also asks for the final financial statements or also reviews the financial statements, final one. So he can also prepare the final analytical procedures. Then comes the third thing. Review the aggregate of uncorrected misstatements to assess whether a material misstatement arises. Okay, this is an important one now. You were auditing a company and you identified that within non-current assets, the property, plant, and equipment, I told the management to correct $1,000 of misstatement. Within intangible assets, I told the management to correct $500 of misstatement. Within all the different things, I told management to adjust 600, 700, 1,000. Individually, these are the misstatements that the management has yet not corrected, and they are saying that we will not correct them, right?
Yeah, because they're
So
immaterial.
you have to look for the misstatements in the aggregate. Aggregate. You sum them all up. And let's suppose the sum of these misstatement is 2,000, 2,700, and then 600 plus 1,100. This would be 3,700 and 3,800. You have found that the total misstatement amount is 3,800. Now you check this aggregate amount. Is it below or above materiality? Is it below or above materiality? Let's read forward. That is how you will get a better understanding. The review is also, okay, let's come towards this one. This point is linked here. Evaluation of misstatements. The auditor must consider the effect of misstatements on both the audit procedures performed and ultimately, if uncorrected, on the financial statements as a whole. The process for it is accumulate all misstatements unless they are trivial. This means if they are of a small amounts, they are very small amounts like $1, $2. These are not misstatements. Auditor always ignore these. But above them, sum them all up, aggregate them all up. Consider whether these misstatements could lead to other misstatements which might not have been identified by the auditor. If yes, then the audit strategy and plan would be revised. This means that you will again need to perform substantive procedure somewhere that you did not perform. For example, if you have identified a misstatement within property, plant, and equipment, and you did not properly audit the depreciation charge within the profit and loss. There is a misstatement within property, plant, and equipment. So what is the expense that is linked with property, plant, and equipment depreciation? Now you will need to audit that as well because there are high chances that there would be a misstatement there as well. Understand?
Wait. Wait, 1 second. Wait. Consider
Yes.
what is included always. But then isn't this the end of the audit?
Yes, this is the end of the audit, but I told you one very
So
important.
like,
Come again. Let me tell
okay,
you. Let me tell you something. Let me tell you a very important concept. The total materiality which was selected for the audit for this company was $10,000. So anything below this materiality amount, the auditor would ignore it. Am I right or wrong?
yeah,
So
correct.
this is something that is linked with practical life. Do not remember this for the exam, please. Do not make this mistake for the exam. But let's suppose the auditor picks up the statement of profit and loss. He finds out that within statement of profit and loss, depreciation expense is recorded and the depreciation expense is only of $9,000. Would he perform any kind of procedures upon it?
No.
No, because it is below materiality, right?
Mm-hmm.
Yes. So now the question is the property, plant, and equipment that you audited, its amount was, let's say, $20,000. You properly audited that. You did all of the substantive procedure and you found $10,000 of misstatement within here. That the property, plant, and equipment have been under depreciated by $10,000. The depreciation expense is currently 9,000. If this is added to the depreciation expense, would the depreciation expense become $19,000? It would.
Yep.
So this will automatically become material. You did not do any kind of procedures in this depreciation case alone because you said it is immaterial. But now you see that it is becoming material. You did not do any kind of procedures. You will now go back towards depreciation expense and do a lot of procedures upon it. Got it? This is how an auditor
Yep.
does during the finalization stage. So you will have to, in the second step, you will also need to look whether these misstatements you have identified because of these, there might be other misstatements which you again need to audit. You have not properly audited them. The third thing,
So because of
communicate.
these misstatements,
Yes.
sorry. So because of the misstatement, you go back, you look if they are linked to other stuffs, and you can audit
Yes.
that.
Yes. Yes. The next thing, communicate all accumulated misstatements to appropriate management and request them to be corrected. So you make a statement. So basically, the auditors have a list, and within this list, I told you they write down. This list is known as SAM, by the way, SAMs. What is the mnemonic for SAM? Summary of all misstatements. Summary of all misstatements. This is known as. So every single misstatement that the auditors identify, they completely write it down. Like $1,000 within property, plant, and equipment, intangible assets misstatement of $2,000. So at the end of the audit, you give this list to the management as well. Some of these misstatements you will write down in front of them. You have corrected it because we requested you, so you have corrected them. But the misstatements that have not been corrected by the management, these are the ones you will specifically share to the management then, and you will request them that kindly correct them. In the next step, if management refuses to make adjustments, then the auditor should assess the misstatements, including the reason of management for non-adjustments, to decide whether they are material misstatements. So first, you will tell the management to
What?
correct these misstatements. Yes, obviously the management would correct them. If in case the management refuses that this is a misstatement, we are not going to correct. You need to sit down with them, because again, you're also a human being. You might make some kind of an error, because there are a lot of judgments involved within financial statements. Your judgment may be wrong. You need to sit down with the management, discuss with them, and tell them, please explain to us what is your reason why you are not adjusting it, because you might be right and we might actually be wrong. You might be right. So please properly explain it to us why you are not adjusting it. So based upon that discussion, you will identify whether this is a material misstatement or not. This is
So
something.
basically,
Yes.
this part is like the individual misstatements. They may not be material, but then when you add them together, they get material. So
Yes.
now, if the money, and then so now you tell the management to
Mhm.
change those individual misstatements. If they
Yes.
refuse to change like one of them, that's
Mhm.
when this happens, right?
Yes. Yes. Correct. You are correct. Now let's come
Wait,
towards
just
the
one second.
next
Let me
part.
read out this.
Obviously, even after discussion, the management would refuse to change some kind of misstatements. They would not accept your own summary. They will say, we are not going to adjust it. What do you do about those? That is also a question. Reassess materiality to determine whether it is still appropriate in the circumstances, as the level of risk may be deemed higher as a result of management's refusal. If the management is refusing to make any kind of adjustments, this raises a doubt upon their integrity. This raises a doubt that there might be misstatements elsewhere and the management may be trying to hide it. So you might need to again assess whether I should lower my materiality or not. Because the lower the materiality, the higher the number of transactions would be tested. The higher the materiality, the lower the number of transactions would be tested. So after this, when the management refuses to adjust the misstatements, you again go back to calculating the materiality, and you find out, is the materiality, should we reduce the materiality? And remember, if you have to reduce
But
the,
didn't you already do that?
come again, come again,
Didn't you already do that? Didn't you already? Did you not already do that?
where did we do it?
Um, Wait, this part. Look,
Which part?
the last one of the first one.
Here,
If
right here,
management,
right here.
yes,
No,
yes.
this is just we had a discussion with the management. We did not change the materiality in this case. Now we are changing the
Okay,
materiality. We are not talking
okay,
about discussing with the management. We have already discussed something with the management. They have refused to adjust the material misstatements. Now there might be a reason that as an auditor, you might need to lower your materiality again, so that the items which you missed out, which were unmaterial before, they will become material, and you will need to test them again now. You will need to test
wait.
them
Let me,
once again.
let me write that down, please.
Because if there is a doubt upon management's integrity, you have to reduce your materiality so that you can test the transactions which you ignored before because they were immaterial. Got it?
Yeah, one second. I'm sure. Okay.
Great. Forwards. Assess whether individually or in the aggregate the misstatements are material to the financial statements. An individual material misstatement cannot be aggregated with other misstatements. Remember this as well, that as an auditor, you will first identify the individual misstatements that are alone material. You will make a separate list of it. And those misstatements alone, which are non-material, you will accumulate all of those and check whether they are coming material or not when we talk about in aggregate. Understood? This
Wait,
is the
what are you trying to say?
I am saying you identified, first of all, understand that your total materiality is 3,200. This is the materiality you have determined. Now
Yes.
you
Yep.
identify that there is
Okay.
a misstatement of 3,500 first in the first place. There is a misstatement of 6,000 in the second place. There is a misstatement of 600. There is a misstatement of 1,000. There is a misstatement of 2,000 as well within the accounts. Now, first thing to do is that in which of the misstatements here are individually material. You do not need to look at them in the aggregate. Which of the misstatements are individually in the aggregate, individually above materiality? This one and this.
35, yeah,
Yes. So you will
3,500
make
and
a
600.
separate list of both of these misstatements. 3,500 is the misstatement and 6,000 is the misstatement. The remaining misstatements were not material when we looked at them individually. So you need to aggregate them now. In the aggregate, you will check whether are they material or not. So you will check, okay, summing them all up, they are material because 21 plus 6, how much is it? 26, 3,600. So
Yes.
$3,600, which is above materiality level. So in the aggregate, all of these misstatements are material. So we'll tell the management you have to adjust these as well. But out
The
of these
aggregated one.
concept, what was the concept that I have even told you previously within the materiality lecture, which I don't want to repeat right now? I told you these are the ones that the management must correct within the financial statements. There is no exception to this. But out of these misstatements, which in aggregate are material, if the management, let's suppose, adjusts this one, just the 2,000, management has corrected this, the remaining misstatements are now these two. Are they in the aggregate material or not? No, not
No.
anymore. So you can ignore this. Okay. Unless even in the aggregate, the total misstatements aggregated amount is below materiality, only then you can ignore it. Unless then you cannot ignore the misstatements. Got it?
Huh? Wait, come again?
I was saying in the aggregate, if the total amount of the aggregated misstatements is above materiality, you cannot ignore them. The management has to adjust some of these misstatements so that the total amount is below materiality. If the total amount in the aggregate is also below materiality, you can ignore both of these misstatements. The auditor can ignore them because they are not material anymore. Got it?
Yeah, can I write this down, please?
Yes, you can write it down. It is written, by the way, here.
Yeah, just 1 second.
Can I move forwards now?
Yeah.
Great. The next step is communicate the uncorrected misstatements to those charged with governance and explain the effect this will have on the audit opinion. So you make a list. Obviously, you have discussed every single thing with the management. We were talking about the management first of all. You discussed every single thing with the management. The management refused to make any kind of adjustment. So you again take this list and you go to those charged with governance. And who are the ones those charged with governance? The audit committee. So you give all of this list to the audit committee and you tell them if these are not corrected, our opinion will change and our opinion will give state that your financial statements are not correct. Okay.
Yep.
This is the second last step. And the last step is request a written representation from the management and those charged with governance that they believe the effect of uncorrected misstatements are immaterial. Now, obviously, as a director of a company or as a management of the company, why would you be rejecting to make any kind of adjustments the auditor is asking you to do and the auditor is stating that they are material? Why would you not do that? Why? Because you think, as a management of the company, even though the auditor is saying this is material, we think that it is not material. According to our own judgment, we think that it is not material. So you need to take a written representation from the management explaining why do they think it is immaterial. You will have to take that written representation. Got it?
Okay.
Great. Give me 2 minutes, please. I am receiving a call. Okay, can we continue?
Yes.
Great. Now, in order, I'm not telling you to learn these points. Obviously, within the exam, it has never been asked, but sometimes the examiner asks within the MCQs as well, like this is the step that you have done already. What is the next step that you will do? So from the MCQs, you will have to select what is the next appropriate step here to do. So, for example, there would be an MCQs within the questions as well, within the exam as well, and you can also find it down within your kit as well. There is an MCQ which states that we have discussed with management that these are the misstatements that they need to correct, and they have refused to adjust these kinds of misstatement. What is the next appropriate step here to do? So there will be different MCQs given to there. And what would be the option correct here? This one. You need to reassess your materiality, first of all, because the management is refusing to correct the misstatement. So this is how the examiner normally asks them. But you don't need to remember these.
Wait, come again? No, repeat the question. How the examiner asked.
I'm repeating. You will find an MCQ, and it is a very, very old MCQ. I'm not even sure whether it is included within the kit anymore or not. There was a very old MCQ in which it was written that we have discussed as auditors all the misstatements with the company's management, and the management has rejected to adjust any of the misstatements. What would be the next appropriate step? And the remaining steps would be written in the different options given for the MCQ. So what would be the next appropriate step here? The next appropriate step would be this one, because this comes right after, if when you discuss with the management and they refuse to make any kind of adjustment. This is, you need to reassess the materiality first of all. This would have been the correct answer there. Got it?
Yes.
So the examiner, what I'm trying to say here is that the examiner never asks rote learned procedures or rote learned steps here. The examiner does not do that, because the examiner has other parts where he can ask it from. And you have seen with the kit as well, there is no such type of a question. These are some things that you just need to have at the back of your mind for the exam. You don't need to learn them. Got it? Now let's come towards this thing that we have missed out. The review is also performed. Basically, the review of the financial statements, when you're finally reviewing them, we were right now talking about the misstatements. But let's just leave the misstatements alone and just come back towards the review. This is the part we have missed out. Why do you always review the financial statements? The audit work was performed in accordance with professional standards. You need to also check that the audit you did was done correctly. You followed all the ISAs, which are international standards of auditing. You did not miss out any of the ISAs. You followed every professional standard. You did not miss it out. The number two thing, significant matters have been raised for further consideration and appropriate consultations have taken place. So we have discussed many different times that, for example, if there is an ethical threat and you have to disclose something to the law authority, to the appropriate authority, to the police department, you need to make sure that you did take lawyers' advice for it. You did take ACCA's advice for it. This is the things that we studied as well. So
So
where
this is like for the auditor.
these are
These
like,
are like for the auditor. What the auditor should do.
come again?
Because the audit work was performed. These are like what the auditor should do.
Yes, these are like what the auditors should do for themselves. So wherever a consultation was required from someone or any matter had to be raised to the audit committee, those charged with governance, you had to discuss with them. You did not miss them out. You have discussed it with them. And if there is anything missed out, you now discuss it with them. Got it? The next thing, whether there is a need to revise the nature, timing, and extent of the work performed. Obviously, in case that I give you the example of depreciation expense as well, once you find out it is below materiality, but now you found there is a very big misstatement within PPE. So now you have to go back towards depreciation expense. So matters like this, you also check to identify whether we need to do the work again, or do we need to do an extended amount of work right now? Do we need to do additional audit procedures on something else that we left out behind? So you check for them as well. The next thing, the audit evidence gathered by the audit team is sufficient and appropriate to support the audit opinion. You clearly remember these two words that I taught you when we were first studying the audit risk portion, and I told you whatever evidence the auditor has to gather, it must be sufficient. This means quantity wise, it has to be appropriate, and also it has to
Sufficient
be
and
appropriate. So qualitatively, it
sufficient.
also should be good. So anything, any evidence you have taken, it is of a good quantity and it is of a good quality. You also make sure of that. So basically, in this step, in the review of the financial statements, you are performing final. What is the major things that you should remember for final review of the financial statements? As an auditor, you check first of all whether the audit you did was correctly done. You obtained the good evidences. Whatever consultations were required, you obtained them. Everything was done correctly. You did not miss out anything. And if anything was missed out at first, you do it again. And on the second hand, these are the ones that were related to the auditor itself. Now related to the company, you check the financial statements to make sure that just finally they are following the IFRS standards. The final analytical procedures have to be performed. You also need to check whether the misstatements have been corrected. If they're not corrected, then you follow.
Can you scroll up, please? Yeah, because I was not seeing it a bit.
Got it? Then you have to follow
Yeah.
these steps for the misstatement. This is why basically you review the financial statements on the final step. Any questions up till now?
I don't have any question, but it's just a lot of stuff. Okay.
It is a lot, but remember, you don't need to learn it. You don't need to get lost in it. Just make sure that you read it once. So that is how you will remember it. So we're done with subsequent events. We're done with evaluation of misstatements as well, where we studied the different types of steps. And then give me 1 second. We are done with going concern as well. What is happening right now with my on? Okay. We are done with going concern as well. We are done with final analytical procedures as well. There is nothing else within final analytical procedures. I just gave you the example and the explanation as well, like what are the final analytical procedures and why the auditors are required to do it. That's it. But there is a question within your theoretical part where I also showed you what are the steps where the auditor is required to do analytical procedures. What are the three areas where the auditor is required to do analytical procedures? And even I told you to learn it clearly because because the examiner had asked them for 5 marks or for 4 marks consistently for past 2 attempts. The examiner stated, what are the steps or what are the areas, the three areas where the auditor has to do analytical procedures? So you first wrote down the initial analytical procedures, the planning procedures,
Oh, the
the analytical
preliminary,
procedures,
the
the interim
substantive,
analytical
and the
procedures,
final.
the final analytical procedures. And these are
Oh, okay.
given within the notes to audit risk or substantive procedures. I don't remember clearly which one, but this theoretical portion I've clearly written it there. So do learn that portion. The next one was the review procedures itself. We are done with this as well. Reviewing the financial statement, the auditor has to check his own things and then also check the financial statements, whether they are made correctly or not. And with these review procedures, final analytical procedures are also linked and the evaluation of misstatements is also linked. So we are only remaining with the final thing that are written
I have
representation.
something to ask.
Yes,
If you are doing questions, which one is more important, the recent questions or like very old
the
questions?
recent ones, the recent ones, the old ones are not that much important.
Okay.
Okay,
Yeah, sure.
great. Now I only have one question from you and I need an answer from you right now. What is a written representation?
It's like from it's like it's a document you obtain from management if what they enter is like it's complete and accurate. That's what I know about it.
Yes. So a written representation is a thing where the auditor tells the management, you say that this is correct, please write it down and sign it for us. That's a written representation.
Okay.
Up till now, we have studied that written representation is the weakest way to obtain an audit evidence. Yes, it is an evidence. Why is it an evidence? Because the management of a company has signed it and given it to you. So it is a type of an evidence, but it is not a reliable evidence. But after you are done with every single thing, there are some very important things that you have to take written representations upon during the end of the audit. And what are those things? You need to remember them. A written representation, a written statement by the management provided to the auditor to confirm certain matters or to support other audit evidences. So here it is clearly written. First of all, remember this. In whatever way, wherever you are obtaining a written representation from the management, you must have done some other procedures to confirm it first. Only after then you can obtain written representation of that area
Oh,
from
so
the
it's
management.
oh okay, wait. You want just give me 1 minute, 2 minutes. I need to get some.
Okay.
Okay, we can continue. Thank you.
Great. So now let's come towards the place which are the areas where the auditors are required to take a written representation from the management and
They
they have to take
must.
it.
Okay.
They must take it. Number one thing regarding the accounting policies, which I just showed you within the Nestle's financial statement. For these accounting policies, you always take a written representation from the management that these accounting policies are correctly disclosed. You take a written representation from the management. You need to learn it. That here, this is the part where you must take a written representation from the management. Got it? The number second
Yeah.
thing, whether the following matters have been measured, presented, and disclosed in accordance with the relevant financial reporting framework. So, what are the plans of the management regarding the company? For example, the company is going really great. The company is making healthy profits. The cash flows are amazing. So you would say the company is a going concern company. The financial statements are correctly made, but the company has not told you. The management, neither the audit committee, neither the board has told you that next year we are closing the company down. We don't know why we are just closing the company down. So what? So then the going concern, the company is not even a going concern anymore. Going concern does not also always depend upon whether the company can continue or not. Whether they do want to continue or not continue, that is also a going concern issue. So you also take a written representation from the management that you plan to continue to do the business for the next 12 months. This is another written representation that you
Wait, but that's not what she said. Plan or intention that may affect the carrying value or classification of assets and
obviously,
liability.
if the management is not planning to, is the management is planning to close down the business, would it affect the classification of the assets? They would not anymore be non-current. They would be current assets. The liabilities would not be anymore non-current liabilities.
But it's
All
not
of them would be
limited to
current
just going
liabilities.
concern.
Yes, come again.
But it's not limited to just going concern.
Sorry, I did not understand you.
I said it's not limited to just going concern.
Well, going concern
Because it
affects the
says,
values
wait,
of
no,
the
what I'm
assets,
saying
does it
is, no,
not?
what I'm saying is, you know, no, what I'm saying is, it says plans or intention that may affect the carrying value. So I mean, like,
Yeah, you can
being a
also say
going
that. You can also say
concern
that.
is not the
For
only thing
example,
that
there is
affects
a
the.
non-current liability recorded as a loan, and the management intentions or plans are that we have a lot of cash, so we are going to pay the loan back within the next year. It has to be recorded as a current liability now. So for the assets and the liabilities, you take a written representation for each of the asset and liability, like what are your intentions for it, so that it is properly classified within current or non-current. Got it? In even upon the going
Yes.
concern as well. The next one, liability is both contingent and actual. Basically, you take a written representation upon them as well that there are contingent liabilities. They have been properly disclosed. There are actual liabilities. We have properly recorded them. Nothing has been missed out. You take a written representation upon that as well. Title 2 or control over assets. If the management has an asset, recorded an asset, you also, even though you have done all the procedures, you have checked the invoices that the company actually controls and owns the asset, still you take a written representation upon the assets that you own it and you control it. You ask for this written representation from the management as well. The next one, aspects of laws, regulation, and contractual agreements that may affect the financial statements, including non-compliance. Basically, all the laws and regulations, all the IFRSs, all any type of contracts that the
It's
company
kind
has
of crazy all of
entered.
this happened at the end.
Come again?
It's kind of crazy all of this happened at the end. I feel like it's like really important. Like I feel like this should happen at the start of the audit.
No, these cannot happen at the start of the audit. I just explained it to you once again, Omi, and I don't think I need to explain it to you once again. If you are the first thing that you are doing is obtaining a written representation from the
Yeah, that's
management,
true. That's true. That's
that
true.
is
That's
the
true.
worst
That
and
is
the
very
dumbest
true.
thing that the auditor can do. After doing all the rest of the audit procedures, once the auditor has done it, the auditor obviously will have evidences against it, that is it true or not. Only after that the auditor will take and do this final procedure, which is the written representation procedure. Even the ISAs, which we don't study within AA, they also say that a written representation must be taken at the last of the audit, not at the start of the audit. They can only be taken once other substantive procedures have been performed. Got it?
Yep.
Great. So, any kind of laws, any regulations that are regarding or relevant to the company, contractual agreements that could affect the financial statements. For example, you entered into a new contract that you will sell something to a customer. It would affect the revenues, the receivables, the contract liability. Obviously, it would affect those. So, Have those been completely recorded or not? Have the laws been followed or not? Are the regulations being followed or not? You take a written representation upon that as well. Keep in your mind, although we are taking written representation upon these, as an auditor, we already know that the company is doing it because we have done other substantive procedures against it as well. We have done many different substantive procedures against these parts for every single thing. But still, as an auditor, at the last, we take a written representation from the management. Because you may ask why, even if we know the company is doing it properly, then again, why do we take a written representation? A simple answer to this is an example. Why do you only have two models under IS 16, that is revaluation or cost model? Why can't you choose any other model? Why can't you use the LIFO method to value inventory? Because it is just simply not allowed by the accounting standard. And just like that, the auditing standards also require you to do this. Got it?
Yeah. So,
Great. You
okay.
can't ask a question like why we are doing it. Because why?
I
The
thought we were gonna ask
auditing
questions.
standards
Oh,
want this.
yes.
Yes. Now ask your question.
Okay. I don't have a question actually. It's just a
Yes.
lot of stuff. Let's continue. There's
Okay.
no question to ask. It's like memorizing it.
No, you don't need to memorize it. You just need to have it at the back of your mind. Just read it.
Uh I'm not. Oh, I sent you a question yesterday. Did you see it on Gmail?
Come again, come again.
I sent you an email yesterday. Did you see
Yes,
it?
I'll see it today, not yesterday. I'll see
That's
it after
actually
the
my
class.
first ever question I actually did on internal audit. Which is so bad to say, but
Great. I'll check it out. No worries. I'll check it out, inshallah.
yeah, please.
The next one, that the directors have communicated all deficiencies in internal control to the auditor. You also take a written representation upon this as well. Specific assertions about classes of transactions, account balances, and disclosures requiring management judgment. So again, you know what the assertions are regarding statement of financial position, the EVCR. What were they? Existence, valuation, completeness, rights, and obligation. You know the assertions regarding statement of profit and loss, the COCA. You take a written
Oh, you know what's funny?
representation on all of them.
You know, we
Yes,
wrote
you take. Yes, yes.
we wrote like asking to say about this. In a statement of profit dollars, we said the cutoff is part of SPL, but it also affects the SOFP. And in multiple questions that I did, that's what I keep saying that.
Yes. And why?
And I
Man, now
explain
you have
why.
understood that. Now you
Let's
have
say why.
understood that. Give me an example. Where does it do it? Where does it happen?
Okay, okay. Let's say you record a receivable, right?
Hmm.
But then yeah, you record a receivable of cash, but you have not delivered the goods. So your
Hmm.
receivables will be overstated. So you could be like inspect the good dispatch note pre and post year end
Yes.
to see when
Yes.
the cutoff was like, or because if a good was dispatched after the year end and you record it as receivable, it's going to be overstated. That's what I'm
Great.
saying.
So you are checking the cutoff. My question is, you are checking the cutoff right now, but to verify what of receivables
To verify the what's it called? Number one, the existence.
and also the valuation of receivables.
Yeah, the valuation. Yeah.
Cutoff is used as a procedure in case of statement of financial position, but it is not verified there. For verification, a verification of cutoff can only be done within statement of profit and loss. But your idea is correct. It can also be linked with the statement of financial position. You are correct in it. And this is something you have learned on your own. So very
Is
good.
presentation the same as disclosure?
Presentation.
Yes. Cause I don't know. Some question they were saying, um, check if the presentation. I don't know to verify. No, they said to verify presentation actually.
Presentation also talks about valuation and disclosure. Basically, presentation is linked with classification.
Okay.
So classification, we don't make a procedure upon presentation because it is too confusing. That is a very easy procedure. You can learn it for your own like well-being and for to learn something to have a better knowledge within the exam. But you don't need to learn it as well. Leave it alone. Like
I'm about to read marking schemes. Okay.
okay, great. So let's move forward. How do you get a written representation from the management now? How do you get a written representation from the management? It's too easy. Written
Order.
by the auditor. Now, remember, this is a way you get a written representation. Listen to this very carefully. Step number one, written by the auditor, comma, printed on the client's letterhead and signed by the client. Appropriate senior person, usually CFO or CEO. So who writes everything within that written representation? What you are trying to confirm, who writes it down?
It's by the auditor.
Yes. On whose paper is it written down? On whose letterhead is it written down?
What's the letterhead?
What's a letterhead? Have
Yes.
you seen many different pages? In which university do you study right now?
Leeds Beckett.
Come again.
Leeds Beckett.
Leads. Leads.
Beckett. BE.
Okay. Just leave. Just talk about leads letterhead.
Okay. Okay.
So
Letterhead.
if you have ever received any kind of communication from a company, let me open up a letterhead of Nestle first. NES.
You like Nestle a lot, I promise you.
Come again, please.
Okay. You like Nestle a lot.
No, I don't like Nestle a lot. This is just an
Yeah, it's
example
like
that I'm
every
using.
example is always Nestle.
Okay, look at this. Look at this.
Okay.
Whenever a company has to contact you, they print it on a piece
Yep.
of paper. Now, this is something that they write. This part is
Yep.
something that they have written. But this part is something that they have not written. It was printed upon every single paper. So they have millions of papers on which this is pre-printed. And upon that paper, they write this down and print it further on. This is known as a letterhead. So imagine a letter that is white, completely white, nothing written here, only this is written there. Nestle's Milk Production Limited. That's it. This is known as a letterhead on which the logo and the name of the company is written, pre-printedly written. Got it?
Yeah, I do.
So every single company have their own letterhead. And again, you will have to print this on the client's letterhead. And who signs it? Who signs the written representation?
Wait, I'm confused with this written representation.
Yes. What is the confusion?
Written representation is obtained from the management, right?
Hmm.
So why are you saying it's written by auditor?
The auditor writes down whatever they have to confirm. They know what they have to confirm. Like
Wait,
if the
I don't
auditor
get
wants,
it.
listen,
I don't
I
get it.
want to confirm that you have 200 pounds within your pocket as you are stating this to me. I want to confirm
Yeah.
this. I'll take, I'll print it out, I will write it down myself and I'll print it upon your letterhead and then I will give it to you. And I'll tell you, sign it. I'll write down upon that piece of
Oh,
paper.
so you're not like, so it's
I'm not
like, you
taking
like,
any kind of risk that you might something write, you might write
what I'm
down
saying
something
is,
else.
I thought like the management would write it and then give it to
No,
you. And
no.
then,
You
I
will
don't know, I
write
was
it
trying
as
to
an
think it to be
auditor,
like
just
this.
like a confirmation, just like a
Huh?
confirmation. You will write it as an auditor and you will print it upon the
Mm-hmm.
client's letterhead and you will give it to the client and the client will read it and accept it. And their acceptance means they have to sign it. Because if I ask you to write down that you have 200 pounds within your pocket to confirm it, you might write down some vague words which can make me liable in the future as well. So I write it down and I give it to you to sign it. And you can't change it. Got it?
Yes.
Great. So if I move forwards now, date of the written representation and date of approval of financial statements should be same.
Huh?
Yes.
Why? Like, this is so weird.
So to make sure that nothing happened between the written representation and the date the financial statements were issued, on which
So what if like the
management
couple,
can
okay,
take any kind of leverage and say there were a lot of changes made. You haven't taken any kind of written representation
okay,
for that. To
that's a
make
bit the
sure the
same.
management can't say that, the date of the written representation and the date the financial statements will be given to the people, both of those should be same.
No, what I'm saying is, um, so like the regional representation, wait, let me think of it in my head. I have a question. So what if like management does not want to sign it? Like when you are trying to confirm from them, like they're against that. So now what will happen? Okay, fair enough.
Got it?
I mean, I didn't get it, but I still okay.
Reliability of written representations. I'm not going to read this one out because we have
Oh my
already
God.
discussed it. That this is not a reliable audit evidence. You must do other procedures first. Only then you should take
What do you
written
mean?
representations. That's it.
Wait, wait.
Steps If written representation are inconsistent with other evidence, consider the reliability of representations in general, reconsider the initial risk assessment, consider the need to perform further audit procedures. This means that, simple words, you audited and you found out that the revenue is increasing because of this reason. Whereas the written representation, management was not accepting it. Now they are stating that the revenue has increased because of some other reason. Written representation that you wanted to take from the management and the actual understanding you have, both are different right now. What has actually happened and what you understand as an auditor, both are different. So you need to go back to the audit again. You need to rethink, have I done the audit correctly of revenue or not? Have I done it properly or not? So you will need to again perform substantive procedures, risk assessment regarding revenue, so you can gain the proper understanding. Got it?
Mm-hmm.
If there are concerns about competence, integrity, ethical values, or diligence of the management, this means if there are doubts about the integrity of the management, the auditor must consider whether the engagement can be conducted effectively. If they conclude it cannot be, then they should withdraw from the engagement where permitted by laws and regulation. If they are not permitted to withdraw, they should consider the impact on the auditor's report, and it is likely that this would lead to a disclaimer of opinion. What is a
There is no
disclaimer
way
of
you want to
opinion?
withdraw.
Leave it. Leave it. We will discuss it in the next lecture when we study auditor's report. So in basic understanding, in basic words,
Okay.
in basic words, if you have doubts about the integrity of the management, then they would obviously sign written representations, even if you have written like the revenue is increasing because of this reason. And even if you have written that there are no deficiencies within the internal control system, even if they have written upon the written representation that there is no fraud that has happened within the company, everything is correctly recorded within financial statements. If the management is a liar management, they would also sign, just directly they would sign this written representation. They would not care about the fact that we are signing something out. They would lie even upon the written representations. You cannot rely upon a management whose integrity is at question. So if that is the case, you might need to withdraw from this engagement. You might have to resign as an auditor of this company, because you cannot then rely
That's
upon
so.
anything.
That's crazy. After
Yes.
all this
So
work.
because you might have a question, sir, then why did we accept this company as our audit client? Because
Yeah,
let's
exactly.
say you accept the company, you have made a mistake, you have made this mistake, you have accepted it during the audit, during making audits risks, during identifying them, and when you were actually making procedures against it, when you were doing so many things, you identified that this company is a lying company. Their management is a liar. During the audit, you identified it. So now you should not continue it. Even on the written representations, they would lie. They are not going to consider any single thing. They would also only need to make sure that whatever you are asking for them, they just accept it. That's it. So you should, as an auditor, you should resign from that company during the audit. You should not even complete the audit. Yes, an auditor can also make a mistake that he accepted a client and he did not properly have an understanding about the management's integrity. During the audit, if he finds something else like this, then he can also resign. Got it? The next thing, which is important as well, steps if management refuses to provide written representation. Let's read it. Although possibly unreliable, written representations are a necessary and important source of evidence. Why? Because the auditor needs to reduce their liability, so written representations must be taken according to international standards of auditing. They are.
Hello.
Apologies, I was receiving a call, Omi.
Oh, okay.
Okay. So let's start. So basically, I just told you that although possibly unreliable, written representations are a necessary and important source of evidence. Why? Because an auditor has to reduce their liability as well. And I've told you this again and again that written representations are the final thing that you do. You don't do this ever in the first step. They are unreliable. And to cover up this unreliability, what do we do? As an auditor, we have done so many other procedures, right? Only after that, we take the final written representations. If management refuse to provide requested written representations, the auditor should discuss the matter with the management to understand why they are refusing. First, you discuss it with the management to gain an understanding from them, like why don't they want to do it? Re-evaluate the integrity of the management and consider the effect this may have on the reliability on other representations, oral or written, and audit evidence gathered in general. This means that at the final step of the audit, if a management is refusing to do something, if they are refusing to sign written representations, this means that all the written representations they gave us during the substantive procedures section, any other information they gave us during the audit, like the revenue is increasing, and they gave us an understanding, they gave us an information that this is the reason why the revenue is increasing, this is the invoices against it. There is a doubt upon all the other information that the management has also provided us. You need to reevaluate that as well. You need to reevaluate the integrity of the management. And finally, consider the implications for the auditor report. You need to consider if the management is not providing you appropriate written representations, whether or not this will have any effect upon your audit report or not. And does it have any kind of impact upon your auditor's report? This is not included within the AA syllabus. You only need to remember these 3 points. That's it. Got it?
Yeah, yeah.
Great. The final one is reporting implication, which we are not going to do it right now. The reason this is regarding auditor's report, and we have not discussed auditor's report at the
Are
moment.
we doing that tomorrow?
Yes, we are doing this within the next lecture that we do. And that is obviously the final thing. So, but what I want you to do,
Can we
is
do it on Monday?
come again.
Or is it too late?
No, no, no,
Can we
no.
do audit report on
No,
Monday?
we can't do that right now. We can't do that. Auditor report needs some time, and you need to have an understanding of this. This is why I want to give you time for this. Unless the understanding of this is properly taken, you can't do an auditor's report. I want you to do one thing, which is important. I'll check out the questions, and the questions you have also sent me up on WhatsApp. I'll check them out. Give me a second, please.